So good evening and welcome to the Bitcoin, Forex and CFDs trading seminar for this evening. Before I do get started, please understand that any advice in today's session is of a general nature only and that your personal circumstances have not been taken into consideration. All right, so what I want to cover this evening is I'll try and take the best part of an hour. I'll cover the Forex market, what it is, how it works, Bitcoin and cryptocurrencies, CFDs, which is the underlying instrument for all of it, how to trade, the market mechanics, risk and psychology, and I'll finish up on the Admiral Academy and I'll show you a little bit of a trading strategy as well. So let's kick it off straight away into Forex and we shall get started. So what is Forex? Well, essentially it's the word Forex is a combination of the words foreign and exchange, and really all it means is the exchange of two different currencies. Now, it's the Forex market is the largest and most liquid financial market in the world, has a daily turnover. Well, this number keeps changing all the time, but it's around about $4 trillion on a daily basis. It can provide us with opportunities both buying and selling, in other words, markets that are going up and markets that are going down. It's what we call an over-the-counter market, which basically means there is no central exchange. Okay, so that's the major differentiator to trading shares, for example, where everything has to be executed via, say, for example, the Australian Stock Exchange. With a currency market, there's essentially your counterparty will be your broker, and it's what we call an OTC market. It has a 24 hours a day trading window, which was my original first attraction to this market, which basically meant I started out trading options and I had to trade those between the hours of 10 and 4 when the stock exchange was open. But Forex, for example, allowed me to trade at 7 p.m. at night, 1 o'clock in the morning, or whichever time slot I had available for me. It provided me a window. It's open 5.5 days a week, kicks off during our summer, 9 a.m. Sydney time on Monday morning, and ends around about 7 a.m. Saturday morning. So who are the participants in this particular market? So what makes it so big? Well, we have governments, countries lend each other money all the time. So they have a requirement to enter this market. So for example, if the US was going to lend money to Italy as an example, there's an exchange of US dollars towards euros. So therefore there would be a requirement for this market. Commercial businesses, if they make overseas purchases or goods that are brought in from overseas, there's different currencies, so they also need to have access to the market. Importers and exporters, which is self-explanatory. Banks lend each other money all the time as well. And finally, there's what I would call ourselves, speculators, who are speculating on the price rate movements, who also enter this market as well. So what does Forex trading actually involve? I remember that I had been working in the industry already for quite a while, and I still wasn't quite understanding what it really was. The simplest way that I can explain it to you is, let's just say that we have a person over here, so let's call him Tony. He's got some Australian dollars, and somebody else on the other side whose name is Jenny has some US dollars. If these two were to exchange currencies, that is essentially a Forex trade. Okay, it's as simple as that. It's the exchanging of one currency for another. Now, the objective is to benefit from a rate movement. So, for example, we would like to buy it at a lower rate and then hopefully sell it when it goes up so that we can make a profit. Sometimes we can't always do this and we end up selling it at a lower level and we can make a loss as well. So you just need to be aware that we can go both ways. Because I am talking about an exchange of one currency for another, it's always quoted, we refer to them as a currency pair, and you'll often see them quoted like Aussie US as such. Now, the first currency is what we call the base or the primary. The second currency is what we call the quote or payment currency. An interesting point to take from this: whenever you do any type of currency or forex trading, whatever the result is, whether it's a profit or a loss on that trade, that profit or loss will always be in the second currency. So if I bought or sold and made a profit trading the Aussie USD, the end result would be a USD profit or loss. What our program, the MT4 platform, will do for you automatically is it will convert that US dollar profit or loss into your base currency that your account has been set up with. So if it was Australian dollars, it will convert it automatically into Australian dollars. Just keep a note of that, because sometimes we amplify a little bit our losses and profits because the currency that we're trading resulted in is a little bit stronger than our own. We normally have a quoting convention, a bid and an ask price. The bid is the price at which we can sell. An important thing to mention here is if you ever look at a trading chart, the price that you will see on your chart is always what we call the sell price or the bid price. There is a way that you can display both at the same time, but by default, the one that you can see is the bid price. Okay, the asking price is the price at which you can buy. Now, and often you can see the quotes as I've just shown you here. So for example, this is when the euro was a little bit stronger than what it is right now. 147.92 the bid and 147.94 the ask. Now the difference between the two, the bid and the ask, is what we call the spread. And why am I telling you this? Because essentially the spread is the cost of doing business for you as a trader. Okay, so with Admiral Markets, we offer you extremely low spreads. And so, for example, you could take a small trade where your spread cost may be as little as 10 cents. Okay, so just be aware of that. Now, the currencies that I'm showing you right now are the major currencies, and these are the ones that are most heavily traded globally, and they have the tightest or the smallest spreads. So when you first start out, if you're particularly new, these are the ones that will be the most cost effective in terms of transactional costs. Okay, notice there that the Aussie dollar is one of those, and even the Kiwi dollar as well. All right, a commonly asked question that a lot of people ask when they're first starting out is, what is a pip? Now, the easiest way that I can explain it to you is, let's have a look at, say, the Aussie-US currency pair, and let's say that the current rate is 74.20, and then there's a 2. So at the moment, most brokers will quote you to 5 decimal places. But what I want you to do is I want you to focus on the 4th decimal place. So if the price or the rate would change from 74.20 to 74.21, just like that, this is what we would call a 1 pip increment. So the pip is actually referring to the 4th decimal place, not the 5th. Okay, a lot of people get confused because now most brokers will quote you to 5 decimal places, but it's still the 4th. Often you will need to know how to work out the value of a pip, because essentially this is how we control the risk of a trade. We can trade where we can make our pip be worth $1, $2, $5, 10 cents, etc. Now, the way that we work it out is essentially the size of the position that you are trading simply divided by 10,000. That will be the value of a pip. So, as an example, if I was buying 120,000 AUD USDs, okay, the pip value would be the 120,000 divided by the 10,000, which is part of the formula, which would give me a 12 USD dollar per pip. So if I go back to that slide where I showed you a 1 pip increment, then if you're trading this size, your 1 pip increment would be 12 US dollars. Okay. All right, so that's a really brief overview on Forex. I could really talk to you for an entire day on it, but I'm just trying to give you the mechanics so that you can basically take something from this and get a better understanding. Let's talk a little bit about Bitcoin, and there's been a lot of hype at the moment. So what exactly is Bitcoin? Well, essentially it's a digital currency. It's a form of currency which is digital. It's called a cryptocurrency due to the fact that it uses cryptography to secure transactions within its infrastructure. Now, Bitcoin itself is the original cryptocurrency. Other major cryptocurrencies include Litecoin, Ethereum, and Ripple. At Admiral Markets, we offer all four of them. You can trade on all four of them. Okay, so these are the major ones. Now, it is important to note right now that there are approximately around about, no one knows exactly, but there's already around about 800 different cryptocurrencies, and of course with Bitcoin being the major one. I'm just going to divert very quickly to a question. Someone's just asked, is a pip and a basis point the same? No, the basis point on your MT4 platform is the 5th decimal place, okay? A pip is the 4th decimal place, okay? And if you're referring to basis points as in interest rates, like 25 basis points, that's a percentage as well. So it's slightly different altogether, okay? All right, so let me carry on. Sorry, I will try and answer questions as I see them. Sometimes I just get a little bit distracted. So how does Bitcoin infrastructure work? Well, Bitcoin offers us the opportunity to make fast, secure, low-cost peer-to-peer payments without the need of a bank or a central processor. So originally it was designed basically for people to exchange money, okay, without the requirement to do it through a bank. So for example, if I wanted to transfer money to my sister, as an example, the only way I can do it under traditional methods is if I transferred it to her bank account. Now with digital currency, you can do it directly from one person to the other person. Now essentially the system transactions, as I said, directly between the users, digital wallets, okay, and they are verified in what we call a blockchain. Now the transactions have a unique digital signature which has a private key which essentially proves who the owner of that wallet is and that the transactions are secure. So what's all the hype about? Well, let's have a look at it. Now essentially it represents something innovative, something new, a forward movement, a unification in the currency for essentially shrinking world, so to speak, shrinking in the world, not physically, but shrinking in the way that it's so easy to communicate with the other side of the world and things of that nature. So it represents something new and traditional, and when something new and traditional comes out, it creates a lot of hype. Now, having said all of that, Bitcoin's been around actually for quite a long time. It's really just starting to explode and hit media very heavily. Really in about the last 6-8 months. Okay, now the way that it's been structured makes it a finite commodity. Now what do I mean by that? Now if I can try to compare it to what we would call a normal commodity, like say gold as an example, in times when there's crisis and war and things of that nature, we often refer to things like gold as what we call a safe haven. And what I mean by that is essentially if everybody's in fear that their currency is devaluing, they tend to move assets into like a commodity like gold. The reason being because there's only a finite amount of gold on this earth. You have to find it, dig it out of the ground, and once it's all gone, we cannot manufacture anymore. Like with currencies, we can continuously print more, and the more you print, essentially the more you devalue that currency. Now the way that Bitcoin has been designed, it has a structure where only an absolute maximum of 21 million Bitcoins will ever be released into circulation, which basically makes it a commodity type structure. So that is very unique about it. So what can I do with Bitcoin? All right. So essentially, you can actually use your Bitcoins to make purchases of goods. There's more and more retailers, and more so online retailers, that will accept Bitcoin for purchases of goods. At the moment, the volatility of Bitcoin is so much so that I think that their values would be constantly changing. Another thing you can do is you can buy and hold Bitcoin, and that's more long term or speculation, and really you're doing it based on the technology and the hope that it does appreciate. We can speculate on its price by trading Bitcoin. This is something that you can do with Admiral Market. So if you were the opinion that Bitcoin was going to get to a certain level or drop to a certain level, well then essentially you can do this. So I already mentioned that there's a finite amount that will ever be released. How do we make Bitcoins? Well, it happens through a process which we call mining. Okay, mining is essentially a record keeping service done through the use of computers. The process involves individuals being rewarded by the network for their services. The more processing of transactions, and remember, the processing of a transaction is really the way that it verifies that the transactions are happening correctly and it's securing the network. For doing that work, the network itself releases Bitcoins and pays those individuals for verifying transactions. It's the easiest way that I can describe it. Now, as I mentioned before about something innovative and new technology, the features of cryptocurrency is that there is no central bank. What does that mean? Central banks essentially can control the printing of money. This cannot happen with Bitcoin and is limited to that 21 million that I've spoken about. The process of mining will release around about one block, which is 12.5 Bitcoins. And at the moment, it's happening at around about 10 every 10 minutes. The block reward will be halved every 4 years until we hit that 21 million cap, and at that point no more can be created. Now it is important to note that even though there will be 21 million, they're speculating that there's already around about maybe 2 to 3 million Bitcoins from the early days that have been lost. The people who own them do not have the passwords for them, and they basically cannot get access to them ever again. So that 21 million number may actually end up being somewhere around about the 17 to 18. So why is it so volatile? Well, news creates volatility. Even when we get news that they say, with statements that say Bitcoin governments will probably regulate Bitcoin, as an example, this creates a lot of volatility. First one is, which government will regulate it, and why do they need to get involved? Okay, so that creates volatility. Perceived value, uncertainty, not knowing what it's all about, that can also cause it. At the moment, Bitcoin is currently being used more like an investment vehicle than to purchase goods. In fact, in the US, the IRS has already defined Bitcoin as an asset for tax purposes, which basically means that most of the people who are getting involved in Bitcoin, they're not using it to purchase goods, but essentially to speculate and hold as an investment or to trade on price. But that being the case, for holders of Bitcoins that have large holdings, it's very difficult for them to offload big positions because in terms of volume, it really resembles more the volume of a small cap company than something with massive liquidity. So a large liquidation influences the market significantly, and this is another reason for major volatility. And finally, people are scared of security breaches in the technology. Now, I know that the technology, they say that it's all wonderful and it's been designed so perfectly, but everybody fears that what happens if they do hack it and they manipulate it, and then we're just back to everything else that is normal about it, a currency. So should I buy it or should I trade it? Well, let me show you some interesting facts, and then you can make your own decisions. I'm trying to stay completely neutral on the matter, but I just want to present the facts for you. One is there is a limited amount. Okay, so that essentially means it has potential for growth. Now, in brackets, I've put in unless the protocol changes. Now, what does that mean? Now, you should already understand that Bitcoin has already, in its short life, split up into 3 different versions of itself, meaning that original 21 million, well, now there's 2 other versions of it which have a different number. So in essence, it's becoming another way of printing more of them or creating more of them, so that will affect its value. Okay, more and more merchants are accepting Bitcoin as a form of payment, so that's an interesting fact. In 2010, so we're going back 7 years ago, Bitcoin started out at 6 cents for 1 Bitcoin. Today, it's worth 14,180. That's before I started this session. Price fluctuations this year alone are from 997 to 14,180. That's a 1,422% movement in price this year alone. The last fact, which I didn't put up on my slide, is, and this is more a cryptocurrency thing, is just understand that there are already around about 800 different types of cryptocurrencies, which is a significant number, so something to be aware of. Okay, all right, let's move on and let's have a look at CFDs. Now, I've spoken about Forex and Bitcoin. Forex and Bitcoin are a type of trade, a type of instrument that you can trade upon. CFD is essentially a vehicle and a method in which to trade the other two. It stands for a contract for different, and it's really just an agreement for to pay the differential in price movements of an underlying instrument, and that underlying instrument can be your Bitcoin, it can be your Aussie US dollar, it can be your BHP shares, it can be bonds, and so forth. Okay? Now, how does it work? Essentially, the CFD mirrors the movement of the underlying assets. So in other words, if your Bitcoin goes up by $1, your CFD of Bitcoin also goes up by $1. If it drops by $1, it will also drop by $1. Okay, so it will allow you to make the differential in price just the same as if you owned the real thing, but without actually ever owning it. All right, so it's important that I say this, that if you did want to get involved with Bitcoin with Admiral Markets, we do not provide a digital wallet. We do, however, provide you the ability to trade on the price movements of Bitcoin, and which will give you the same benefit as if you owned the real thing. Okay? Now, essentially, so now that we know what a CFD is, well then what's the purpose of them? Well, essentially it's a derivative product and they allow leveraging. So for example, with your currencies, we can leverage up to 500 to 1, and with Bitcoin, at the moment we allow you up to 5 to 1 leverage, and I believe as from next week that leverage will change to 10 to 1. Okay, but currently right now it's still at 5 to 1. Okay, so when you trade with a leveraged product, the trader needs to put up what we call a margin. Margin is essentially the security deposited by the trader that enables them to participate in the CFD agreement. Okay, leverage is the way that we work out how much margin we actually need to put up for the trade, and I'll show you exactly what I mean. So let's say we were looking at a Forex trade. To work out margin, the formula is very simple. It's the size of the trade divided by the leverage. So let's say that we were going to buy one lot, which is 100,000 of Aussie USD with leverage of 500 to 1. You can get 500 to 1 leverage with Admiral Markets. So the way that the formula would look then is 100,000 divided by 500, and then that means that you would need a minimum of $200 in your trading account to be able to physically take a one lot trade. Okay, now if you only had $200, that would be an extremely large trade for an account that size, but nevertheless that's the margin that you require. Let's have a look how it would work for Bitcoin. Again, the formula is the size of the trade divided by the leverage. This time, if we were to buy one Bitcoin, the leverage is 5 to 1, and I said from next week it's changing to 10 to 1, but for now it's 5 to 1. It's the price of one Bitcoin, which is 14,180, divided by 5, which means you would need $2,836 in your trading account. Otherwise, you would not be able to buy one Bitcoin. Important thing to note though is we actually allow you to buy a fraction of a coin, where the smallest trade size that we allow you is 0.1, which means you would need 283 instead of 2,836. Okay, if you have a demo account, please feel free to do a couple of demo trades so that you understand the mechanics of what I'm talking about. All right, let's have a look at market mechanics and how to trade. All right, so we start to piece all the pieces together, and let's see if we can come up with some kind of a better image. So how does it work and where do we fit in? Let's just say that you're starting out. How does it work? So here we are, and we've made a decision that we wanted to interact with the financial markets and we want to trade. So the first step is you need to find yourself a broker, such as Admiral Markets. For example, your broker will give you access to your currency CFDs. Now, if you ever see the word FX, it's short for Forex, okay, which is the same as foreign exchange. All right, so you get access to your currencies from your broker, your commodities, your indices, access to your stocks, and also access to your cryptocurrencies, so where you can trade your Bitcoin, for example. Now, essentially, you become part of your broker's network, and your broker will also be servicing many other clients as well. Now, when you place a trade through your broker then places that trade out to its network, and its network is comprised of different banks and different liquidity providers. Okay, so one thing that we often forget is that if you make a decision that you want to buy one Bitcoin or you want to buy $100,000 US dollars, okay, there has to be someone in the market that wants to sell you that Bitcoin or sell you that amount of currency. If there is not, basically there will be no transaction. All right, it is the most liquid market in the world, but we still need to remember the basics of a simple trade. Okay, now so your broker will push your trade out to the market so that it can fill your order, and then you get your order filled. Now, essentially, this entire network becomes, let's call it, one market. And remember that I spoke to you a little bit earlier about this type of market is what we call an OTC market, or an over-the-counter market, because there is no central exchange. Well, this one market, which we already saw, was comprised of yourself, your broker, and all the banks and liquidity providers that deal with your broker. That was one market. Now, that one market forms part of many other markets that all talk to each other, and this is how your orders are filled, which is totally different to every single order going to one stock exchange and being filled at the same place. Okay, so hopefully I've given you a very good visual on how orders are handled and how they are processed throughout the market. All right, so now let's start to analyze the market. How do we do it? Well, the first step is we need to capture price movements and activity. Now, the simplest way to do it is with a candlestick chart. This is what they look like, if there's anybody there that does not know what they look like. And if I zoom in on the specifics of a candle so we can all see a little bit better, I'll cover the green one first. If we look at, let me see, if we concentrate on this section here, this is, let's say that this particular candle is capturing data for an entire day, so it'll be called a daily candle. Well, if it's in green, the bottom of the candle, this section here, is essentially what we call the opening price or the opening rate. Throughout the day, it got to the lowest level here, highest level up there, and at the end of the day, the closing rate was up here. How do I know that? Because it's colored in green, and at a quick glance of the eye, I can see that this type of day was an up day. So throughout the whole day, the price started lower, closed higher, and the two little, what we call candle wicks, were the extremities of the day. Okay, so that's a simple explanation. The red one is identical, but just in reverse. So we've got a method to capture the data. Now we are going to analyze charts in a technical method. Before I do so, there's a couple of assumptions that I want you to take and understand, so that we're going to utilize to help us analyze price movements, so that we can try and find probability trade opportunities with a higher probability. The first one is market moves. The market movement embodies all the available information. The second is history tends to repeat itself. And third, price action will move in trends and patterns. So let's just keep this on our back burner. We're going to go in with this knowledge, and this is going to help us in analyze price activity. Our technical analysis can be divided into two types of analysis, with the first being what we call quantitative analysis, which is really the use of what we call technical indicators. Technical indicators are things like MACDs, Bollinger Bands, things of that nature. Okay, and the other method is the graphical analysis. This is more traditional type of analysis. This involves utilizing things like support lines, trend lines, channels, triangles, all pattern trading, all those types of things. Our main goal in technical analysis is really to study the price action of the market and use the principles that we have defined to assist us in finding the highest probable outcome. That's it. Now, it's important that I highlight this for you, and I'm talking about only a probable outcome, because we never really know what's going to happen next. Okay, so that is very important to highlight for everybody. Let me show you this particular chart as an example of a little bit of analysis using a graphical method. You can clearly see above on this top yellow line, which is a level of resistance. Essentially, price has come to this level and it has rejected off. It's done it a second time and rejected off again. When we get there on the third time, you could, as a probability type scenario, say, well, there is a good chance that it could happen again. Okay, because remember, we're utilizing the principles of history repeating itself and graphical analysis. All right, so that one there would be trying to look at something and analyze it based on a graphical method. Looking at the same identical chart, okay, it doesn't look the same, but it's the same identical chart. This time I can observe, lean with the use of my technical indicator. When I look at my stochastics indicator down the bottom, at the point where they're crossing over here, if I draw a line and I go up the top here, this actually is the same point that previously I had as a rejection point, but this time I found the same identical position in the chart, but not with my graphical method. This time I found that with my stochastic indicator, which is a quantitative method, and it too could have given me the option of a higher probability trade. All right, so, and that was simply with a different method. To increase your probability even further, you could merge both methods together and notice that there was resistance happening, and at the same time of that resistance, we also had our stochastics indicator indicate a turning point. With this in place and that in place, the probability is even higher than just one alone. This is an example of the things and the processes that we go through in making our trading decisions to try to find our most highest probable scenarios. Now, I run the Admiral Academy for trading, and I go into extreme depth with the analysis of charts and assistance in how to basically find and observe trades for yourself. Okay, so just keep that in mind. All right, so let us quickly look at two topics that I genuinely could talk to you all night over: risk and psychology, which are extremely important in the elements of trading. Now, risk management is really a very key function to your success in trading the markets. In fact, your risk management represents around about 30% of your success, of your overall success in trading, full stop. As a rule of thumb, a professional trader will usually risk anywhere between 1 to 3% of their capital per individual trade. Now, if you have a smaller account, like a $500 account, generally you may want traders may push this number a little bit higher because it's just so small. But as the account sizes get larger, these are the guidelines that are highly recommended. So as an example, if you were to trade and risk 25% of your account per individual trade, if we get 4 trades wrong, essentially you've already blown up your account. Okay, so that just gives you an idea of the impact that it can have for you. Here's a couple of things to think about when you're talking about risk. Well, the first one is, how much do you want to risk in terms of dollars on a single transaction? Okay, have that thought in mind before you start your trade. Very, very important. Where do you place your stop loss? Your stop loss is the point at which you exit the trade with a loss, but you prevent further losses. Where do you get out with your profits? Often people don't think about these things, and they're very, very important. And finally, what is the risk reward to your trade? So, for example, if you're risking, are you risking $10 to make $1? Are you risking $10 to make $30? Just understand your risk reward so that you're on top of the risk management side of it. The psychology of the trader. All right. So essentially the psychology of the trading is, in the simplest way that I can put it, and it's a difficult concept to grasp, but essentially it's the sum of every thought that you've ever had regarding trading, including whatever you're thinking right now, whether you've traded already or whether you have not traded. Okay. Your psychology represents around about 55% of your success in trading. It is one of the most important elements in trading, and one of the most difficult to conquer and to manage throughout your trading careers. Here's a couple of things that will definitely assist you. One, create a trading plan. The purpose of a trading plan is essentially when something happens in the market and you're not sure on what to do, we don't want to make emotional decisions on the fly. What we want to do is we want to refer to our trading plan and see what the plan says and just follow the actions that were written out when you were calm and relaxed and you gave it the genuine thought that it needed. Okay, so create a trading plan. Very, very important. We need to change our limiting beliefs to become better traders, and we need to analyze our trades, fix and repair losing trades, but preserve and strengthen your successful trades as well. Okay, so these are a couple of things that are very, very important for you to keep an eye on and track your success. Now, if you want more details on risk and psychology, please get in touch with us, because I've got I've got hours and hours worth of material that I can share with you, but I'm just touching on this very, very quickly. All right, let me talk to you finally about the Admiral Academy, what it is, how it works, and I want to also give you an example of a trading strategy so that you can physically go out and look at some trading charts for yourself and understand what constitutes a trading strategy and essentially how it can work. Now, if you're fairly new and this is a little bit above and it's not making sense, look, that's okay. You can come back and it'll make more sense a little bit later. All right, the first step is I'm going to need a couple of technical indicators set up on my chart to be able to use this particular trading strategy that I'm going to show you. The indicator that I want is a Bollinger Band. Over here, a Bollinger Band, and I want you to have a setting of T equals 20 and deviation of 2. Okay, this is very, very important. So just please note that. The best way for me to show you, so take a screenshot of this if you want to just keep it, but the best way for me to show you the strategy is to jump straight into a chart, and it'll be easier for me to show you. Okay, so the first step here is I'm looking at a chart. Now, the time frame, you can use whatever time frame you like. I particularly like this strategy with a 1 hour chart, even a 4 hour and a daily. Okay, but a 1 hour seems to work really, really good. Now, these lines here that you can see that I'm highlighting, these are my Bollinger Bands. With this one is my upper one, this is my lower, and this is, you guessed it, my middle band. So they're the Bollinger Bands that I just spoke to you about. And the first rule that I want to explain on this strategy is we need a candle to open on the inside of the Bollingers, so anywhere in here on the inside, and it has to close on the outside, top or bottom, doesn't matter which one we look at. So we're looking for situations where candles are opening on the inside and closing on the outside. So for example, this candle here opens inside, closes outside. This opens inside, closes outside, opens inside, closes outside. Okay, so those are 3 examples. Now, I want us to focus on this particular one over here. Once you've had the candle that opens on the inside and closes on the outside, rule number 2 is the immediate candle that follows has to do the opposite. So in this particular case over here, this one opened in, closed out. The one immediately afterwards opened out and closed back in. Okay, so we need a matching set. These 2 over here also did that, but for the purpose of these examples, I've used this one, but this one also did it, and in fact, so did this one. Okay, so there's actually 3 examples in the one piece of chart. All right, okay, so once you have a situation where you opened in, closed out, and then vice versa, the next thing that we do is we will open our trade at the opening of the next candle, which is over there. So let me show you. And the trade is in the direction back in towards the middle of the Bollinger Bands. This strategy is a turning point strategy. It's a strategy designed to find points of inflections as such. So just keep that in mind. All right, so that's the direction of the trade. Next, we need to manage our risk. Place your stop just above the higher of the two candles. And normally, depending on what time frame you use, you could use maybe 2 to 5 pips past the highest point. The highest point is that little wick over there. That's where you place your stop. And apply a risk reward of, look, 1 to 2 can work generally very good. All right, so you can see over here, I'm risking, let's say 1, look at the distance here, to possibly make 2. Okay, so that my distance that I want to go in is twice as big as my risk. So in other words, if I was trading at a risk of $10, my reward would be $20. Pretty straightforward. Okay. All right, so that's essentially a simple example. And I've gone very, very quickly. Like, I take a lot longer and I look at many, many examples to show you how this particular strategy works best, the types of markets that it works well in. But this is a quick example of what a strategy is really all about. So I mentioned the Admiral Academy, and I've just shown you a strategy just to get a taste of sort of what you will get. Essentially, the Academy it's a comprehensive education program which has been built by our partner educator, which is called CSC Traders, and it's basically designed to guide, teach, and develop the trader that is within you. All right. Now, what does it comprise of? What do you get? Essentially, we will provide you with 7 trading strategies, okay, and they're all provided via CSC Traders. The strategies will be price action based strategies, swing, pattern trading, counter trend trading, Bollinger points, wave tracking. So essentially 7 different methods designed to expose you to different types of trading so that you can find the one that suits your personality the best. For example, there's a strategy that I absolutely love to trade, but it doesn't suit my lifestyle because it means that I have to be up at 3 o'clock in the morning. So it's not a method that, even though it's a successful trading strategy, but it's not a method that works with my lifestyle. So I expose you to many different styles just so that you can find whatever naturally fits for you and your personality. That's the one that's going to have the highest chance of getting you to a more successful trader. Okay. I provide a daily trade idea every single day, and essentially this is an example of the charts. Every day I find the chart, I look for the highest probability chart for the day, and I send it out to our clients just so that you can monitor it. You can, if you're learning, you can track its behavior. You can start to get a feel for the market. If you've spotted it yourself, it gives you a feel-good factor that you're on the right track and you're developing. And many of our traders really use it as a signal in itself. It's up to you what you do with it, but I try to find the highest probability trade, and I usually send it out before 10 o'clock every morning. It's part of the Academy. Okay. You also get a daily market analysis, which I talk about the major events that happened overnight, major events that are occurring today, and talking topics that could affect the market significantly for the trading session, which is about to kick off. So that happens every day. And that comes in the form of a video. It's roughly about a 2 to 3 minute video, which is produced every day, and it's ready to watch usually by about 9 o'clock, but I just, as a safeguard, sometimes I'm running a little bit late. I say by 10 a.m. You will get one-on-one support. Okay, so as long as you're a client with us, I will support you. The only thing that I ask is talk to me with charts. In other words, I want you to take a screenshot of your chart, ask me your question, email it to me, and what I do is I will draw on your chart, I will answer your question, and I'll email it back to you. So as an example, this was a chart that a client sent to me asking me, I've drawn my support line over here. He drew the yellow line. The line that the client drew was the yellow one, this one over here. And he was asking me, is this a correct point? Have I drawn this correctly? And quite clearly, I explained to the client that this point over here was not a correct point. This was the correct point, and I redrew the line for him and with the explanations, and I emailed him back. I'm very, very quick in terms of my responses. I usually block out a good 30-40 minute section of my day just to respond to emails, and I can whip out 30-40 responses very, very quickly if you send me a picture. Okay, so you'll get one-on-one support as long as you're a client with us. I provide one live class every Monday. You can come to our classes. You can bring in all your questions from the week. I trade live in the class. I analyze the markets and essentially set homework, answer your questions, and it's a session to confirm and to learn and to develop. Okay, that happens every Monday. I have a module specifically on trading psychology. Like I just talked about it today for about 3, 4, 5 minutes. I can literally go on a whole day on it. So I have extensive modules for you to develop your mental strength. It's my specialty. The trading psychology is the most important part for trading, in my opinion, and I treat it with the most respect that it deserves. We also have auto trade management software. We can do things like a lot of the strategies that I use. I implement this, like for example, when my trade gets to this point, I want to close out 20% of my trade, move my stop loss automatically, and project a new profit target, for example. So we have software that will do that for you automatically. I teach you how to use it. It's easy to use, and it just helps you psychologically cash in bits of your profit as you're going along, and helps you stabilize better mentally as a trader. We also can give you access to auto charters that helps you find different charts and patterns, so that's available to you as well. You'll get your own personalized account manager who you can ask anything regarding your account. If it's anything about trading, I'm the person to ask, and I handle every trade question personally myself. So how much does it cost? Well, look, essentially, it doesn't cost anything. It really is zero. The only condition to get access to it is you just need to have a trading account with us, and in your trading account, everything that I just showed you, you can get access to it for free, and you just deposit $2,500 of your own trading money into your account. That's the money that you're going to use to trade with, and you've got access to your funds at any time, just like any other normal trading account. If you're an advanced trader or you want to take your trading to the next level, I also do what I call a live workshop, which essentially I spend an entire day with you, and it's maximum of only like 4 to 5 people at a time. So you get one-on-one time all day. It's an entire trading day. The next one is in January. I haven't locked in a date yet, but it'll be towards the end of January. It's fully catered. It's in our Sydney offices in Martin Place. I will teach an additional 4 trading strategies, including my personal methods that I trade with. You bring your own laptop. I will load in all my custom indicators and profiles for you, so when you leave, your charts will look identical to mine. Again, small groups, maximum 6 people at a time. I trade live on the day as trades present themselves, and essentially it's the ultimate trading experience. You get all your questions answered. The best way that I can describe it is you can go get a golf lesson, for example, spend half an hour with a golf pro at the shop, or you can go and play 18 holes with him, walk around the golf course, get inside his head, see how he deals with different situations as they present themselves. I am in a live trading market environment, so different things pop up. You will see how I react to live trades, the risk management, and all those types of things. How do you attend the live workshop? Well, simply open a trading account, you are taking up one entire day of my time, and I only work with people who genuinely want to go to that next level. So it's people that have a larger trading account, and it's a minimum of 7,500 in your trading account. Again, you're not paying this. This is just your trading capital, and we're happy to work with you if you're at that level. Okay, now usually those two that I've shown you, if you go to our website, it's 15,000 and 5,000. But like I said, as a webinar special, it's 7,500 and 2,500 respectively. Again, I'll just show you everything that you do get. Now, I know that there's education companies out there that will charge you in excess of $5,000 just for the intellectual property. We have a special arrangement with CSC traders who allow us to provide the material to our clients, essentially making it no cost for you, the client itself. Okay, the only requirement is that you are a client and you have a trading account with those equity sizes, and you're going to need that money to trade anyway. So essentially, if you decided that trading is not for you and it didn't work out, or psychologically it didn't fit your profile and you withdraw your funds, well, then that's fine. We're not going to charge you for that intellectual property. In many ways, I feel that we've assisted you in discovering that this perhaps is not for you, and essentially we basically move on. Okay, so those are the things that you get. I'll put up our email address there. If you could, if you're interested or you wanted to ask any other questions about it, just send us an email. Tell me what you were interested in, ask your questions, and one of our account managers will basically respond to you and get in contact with you. They can set up a one-on-one time to go into detail. Some of the things that I'm showing you here, they can actually log you into their systems. They've got access to it, and show you themselves personally, to possibly assist you to take your trading to the next level. Okay, so there you have it, guys. I hope it's been a brief one. Apologies for the delayed start. I had a technical issue that could not be salvaged, but nevertheless we got through it. So if you do have any questions, please get in contact with us. Just send us an email and we'll be more than happy to respond. Other than that, hope you'll have a fantastic night. Thank you for listening, and if you do come on board, I look forward to seeing you in our rooms, and take care. Bye for now.